So in this video, we will try to understand why do we make certain money decisions. And without further ado, let's go straight into the video. See, we all come from different generation, with a different location, with a different education, with our different lifestyle, with a different environment that we are living in. Basically, we all have a very different experiences towards money. We just gotta say that how you handle your finances is linked to your psychological quirks and experiences as well. And now we will have 4 groups of people who was born in different time periods in the past. And we will study how the stock market performed during their formative years and how this can have significant impact on their financial perspectives and behaviors with money. So the first group of people born in the 50s. Those born in the 50s saw the stock market perform poorly during the 60s and 70s, characterized by economic stagnation, high inflation, and various geopolitical crises. So this period of sluggish market growth and the unstable economy could have led to hesitation about the reliability of the stock market investing, making this group of people more cautious and conservative in their investment strategies. The second group of people born in the 60s. People born in the 60s encountered high inflation during the 70s and early 80s. The oil crisis, stagflation, and volatile interest rates were significant economic features of this period. So the experience of high inflation likely made this group of people aware of its dangers, and they might prioritize investing that hedge against inflation, such as real estate or commodities. The third group of people born in the 70s. Individuals born in the 70s grew up during the 80s and 90s, a period marked by a significant growth in the stock market. The S&P 500 experienced a dramatic increase, reflecting a good bull market. So witnessing such a robust market performance likely instilled a positive perception of the stock market in these individuals, and they may have more inclination towards investing, believing in the long-term potential of the stock market based on their early experiences. Born in the 90s. Those born in the 90s have lived through a period of relatively low and stable inflation, especially after the 2008 financial crisis, when central banks around the world implemented policies to maintain a low inflation rate. So growing up with a low inflation rate might result in a less concern about its potential impact, and this group of people might prioritize other economic risks and opportunities and possibly underestimating the effects of inflation because to their lack of exposure to its more severe consequences. Now, these generational perspectives underscore how personal experiences with economic conditions during one's formative years can significantly influence the financial behavior and attitudes toward investing and the risk associated with investing as well. Now we will make a comparison between 2 people who lived in a different places, and we will see how they will act with money. Person A, who is living in a third world country, and person B, who is living in a developed country. So we're gonna make the comparison in the environment, in the saving and emergency funds, in the investing strategies, in the spending habits, and finally in the financial literacy and trust. Environment. Person A grew up in a country with unstable economy, high inflation, and possibly limited access to financial services. And also he may experience unstable political situation, currency devaluation, and limited job opportunities. While person B grew up in a stable economy environment with low inflation, robust financial markets, and comprehensive financial services. And he may experience a stable political situation, strong job market, and access to diverse investing opportunities as well. Saving and emergency funds. Person A is likely to prioritize saving money because of their unpredictable economic environment, and he might maintain a significant emergency fund to stand against economic shocks or personal financial crisis as well. While person B might maintain moderate savings, relying on the stable economy environment that he is living in, and also relying on the social safety nets as well. And they are likely to have an emergency fund, but it may not be as large as the person A because of their higher confidence in their economy. Investment strategies. Because of the unstable economy, person A may prefer low-risk investments such as gold, real estate, or stable foreign currencies to protect their saving from devaluation, and their investing options may be more restricted focusing on tangible assets rather than stocks or bonds. While person B may have high risk tolerance, investing in a diverse portfolio that includes stocks, bonds, mutual funds, and other financial instruments as well, with easy access to sophisticated financial markets and tools. And also, they might actively engage in a long-term investing strategies, such as retirement accounts. Spending habits. Person A may adopt frugal spending habits, focusing on essential needs and avoiding unnecessary expenditures to safeguard their financial future. And they are likely to prioritize spending on essential items like housing, health, food, and education, while person B may have more inclination towards spending, which is spending on non-essential items driven by a high income and economic confidence. And also they might prioritize lifestyle enhancements such as travel, dining out, and entertainment, etc., etc. Financial literacy and trust. Person A might have a lower level of trust in the local financial institutions, possibly relying more on informal saving methods, and their financial literacy might be shaped by necessity, leading them to be more cautious. While person B is likely to have higher level of trust in the local financial institutions, making the use of banking services and credit facilities as well. And they might have high financial literacy as well, benefiting from a better financial education and better resources as well. So at the end, I will say to you that all these factors that we mentioned will affect your decisions in some way or another.